Welcome back to the deep dive. Today we are walking into the engine room. We're tackling a topic that the documentation describes as the most powerful, most complex, and definitely the most tested area of SAP sales and distribution. We are talking about pricing.
The engine of profit.
That's a heavy title. But, looking at these sources, it feels earned. There's this great line in the material that says, pricing is the precise point where business creativity collides with system discipline. I love that image. It sounds violent.
It often is.
Right. Because you've got marketing coming up with these wild ideas. Buy 3, get 5% off, but only on Tuesdays if you're a gold partner and the moon is full. And then the system has to actually make that math happen.
It has to happen instantly. And it has to be auditable and accurate down to the penny. The stakes here are just incredibly high. In other parts of the system, if a delivered date is off by a day, people get annoyed. But when someone says the price is wrong, that is a loaded phrase.
It's the ultimate complaint.
Exactly. And the price is wrong could mean, well, anything. It could mean a missing volume discount. It could mean the freight wasn't applied, the transfer pricing failed, or this is the one that drives CFOs crazy. The rounding is off by a single penny.
Which sounds trivial until you multiply it by 1 million invoices.
Precisely. That's millions of dollars in revenue leakage or, overcharging, both of which can kill a business relationship. So if we're going to master this, the sources suggest we need a mindset shift. We need to move from the perspective of let's say, a junior configurator who just prays the price, shows up on the screen,
to a solution architect who uses pricing to actually control revenue, margins, and even customer trust.
That's the goal.
So let's unpack the central framework that controls all of this chaos, the famous or infamous condition technique.
Right. So the first thing you really have to wrap your head around is that SAP pricing is, it's rule-based. It is not hard-coded. You aren't writing traditional if-then code for every customer deal.
Which is good, because if you were hard-coding every price change, you'd never sleep.
You'd be rewriting the software every time the price of oil changed. Instead, we use the condition technique. Think of it as structured flexibility. It allows the business freedom, but within very tightly controlled rules, and it rests on 4 pillars. If you get these 4 right, you can build almost anything.
Let's walk through them, but let's do it logically from the ground up.
Yeah.
The source calls the first pillar the where to look. Condition tables.
Think of condition tables as defining the key combination. It answers the question, who gets this price? Is this price for a specific material? Or is it for a customer and a material? Or maybe a customer, a material, and a specific currency?
And there's a golden rule here regarding priority, right? Because what if I have a price for the material generally, but a special price for this specific customer? Which one wins?
The rule is specific beats general. The system is always going to look for a customer-specific price first. If it finds it, it stops. If it doesn't, then it falls back to the general material price.
But here's a senior insight from the notes that really stood out to me. Do not design tables based on imagination.
This is a classic rookie mistake. You're sitting in a workshop and you see a field like division or sales office, and you think, oh, maybe we'll need to price by sales office someday. So you create a table for it.
Just in case.
Just in case. But if the business never actually prices by sales office, you have just created technical debt. You're forcing the system to check a table that will always be empty. It confuses the users and it clutters the system. Only build what reflects the actual business pricing logic.
That leads us perfectly into the second pillar, which is the how, the access sequence. This is effectively the search strategy.
This is the intelligence of the system. The access sequence tells SAP which tables to check and in what order, usually from most specific to most general.
And crucially, it tells the system when to stop looking.
That's the exclusive flag. It's vital. If I find a special negotiated deal for you, I stop. I don't keep looking for the list price.
The source makes a really interesting distinction here between junior and senior consultants regarding these sequences. It says juniors tend to create new access sequences for every little requirement, but seniors reuse and optimize. Why does that matter?
Performance. Every step in an access sequence is a database read. If you have an access sequence with 50 tables and a sales order has 100 lines, the system is doing thousands of reads just to open the screen.
So the sales rep hits enter and then just sits there waiting for the wheel to spin.
Exactly. And in a high-volume call center, a 5-second delay per order is unacceptable. That sales rep is on the phone with a customer who is waiting. A senior consultant knows that a bloated search strategy kills user experience. Efficiency is part of the design.
Okay, so we know where to look and how to look. Now we need to know what we are looking for. Pillar 3, condition types.
This is the semantic meaning of the money. Is this money a base price, like the standard PR00? Is it a discount, like K007? Is it a tax, like MWXT?
And inside these condition types, you have all these little levers and switches. You can set it to be a surcharge or a discount. You can make it a fixed dollar amount or a percentage.
And you control the behavior. For example, can a user manually change this price on the sales order? Or is it locked down? That configuration lives inside the condition type.
This seems like a place where things can go wrong if you aren't careful. If you leave a condition type wide open, can't a user just type in whatever they want?
They absolutely can, and we'll talk about that margin leakage in a bit. But yes, the condition type is where you set the boundaries of what is allowed.
Finally, the fourth pillar.
Yeah.
The pricing procedure. The calculation schema.
The engine. The calculator. This defines the order of operations. First, we find the base price. Then we deduct the discounts. Then, and this is important, we calculate the tax on the remaining amount. Then we get the total.
It seems straightforward, but the notes mention subtotals and requirement routines as being critical here.
They are. Subtotals are like memory buffers. You might want to store the net value or the tax basis in a specific bucket so you can use it later for reporting or for transfer to accounting.
And requirement routines.
Those are little logic checks. For example, only apply this discount line if the customer is a wholesaler. If that check fails, the engine just skips that line entirely. It prevents the system from applying logic where it doesn't belong.
So that's the framework. Tables, access sequences, condition types, procedures. It's a machine. Now let's get into the anatomy of a price. What are the actual organs inside this body? It all starts with the base price.
Usually PR00, it is mandatory. If you don't have a base price, you have nothing to calculate a percentage discount on. You can't take 10% off of zero.
Then come the discounts and surcharges. This seems to be where the money leaks out if you aren't careful.
Huge risk area. The sources mention a common configuration error, allowing unlimited manual discounts without authorization keys.
So a sales rep just types in 50% off because they want to close the deal.
And the system lets them do it. Your margins evaporate instantly. A solution architect ensures there are limits. Maybe they can give 5%, but for 10%, it triggers an approval workflow.
And on the flip side, surcharges,
Uh-huh.
small order fees, urgency charges. The senior tip here was to map these to service revenue GL accounts, not product revenue.
Right, because you want to track that separately. You want to know how much you earned from selling the widget versus how much you earned because the customer needed a rush. If you lump them together, your product analytics are skewed. You think your product is profitable, but really you're just making money on shipping fees.
Now let's talk about the one thing nobody likes paying, but everyone has to. Tax. GST, VAT, sales tax.
Legal compliance, it is not optional. And in SAP, tax determination is surprisingly complex. It looks at the departure country, the destination country, the customer's tax classification, are they tax exempt, and the materials tax classification.
It's amazing how many variables go into just that one line item.
And if you get it wrong, the government comes knocking. It's not just a customer service issue, it's a legal one.
But then there are the hidden elements. The stuff the customer might not even see on the invoice, but is crucial for the business, like VPRS.
VPRS is the internal cost. It's statistical, meaning it doesn't change what the customer pays. But it pulls the cost from the material master so the system can calculate gross margin.
Why does the sales system need to know the cost? Isn't that a finance thing?
Sales needs it because if VPRS is missing or wrong, your profitability analysis in the sales report is garbage. You might think you're making money on a deal when you're actually selling below cost. VPRS is the reality check.
And then there's the cash discount, SKTO. This one always confuses people. 2% net 30.
It is a financial incentive, not a trade discount. The key distinction the source makes is that SD calculates it just for information to show the customer, hey, you could save this much. But SD doesn't actually deduct it from the invoice value. Finance realizes that discount when the payment actually comes in early.
Right. And then the big one for audit sensitivity, rebates.
Deferred discounts. Buy $1 million worth of stuff this year, and we'll give you 2% back at the end. The catch is, you have to accrue for that payout with every single invoice. You post a provision to the general ledger.
So you're setting money aside as you go.
Exactly. You are booking a liability. And auditors watch this like hawks because companies can use rebate accruals to shift profits between quarters. If you accrue too much, you reduce your profit now. If you release it later, you boost your profit then. It's a very sensitive area, so the configuration has to be airtight.
One thing the notes emphasize is the difference between configuration and master data. It says configuration defines the logic, the container, but condition records define the money, the content.
And that is a vital distinction. You configure the rule that says we can have a customer-specific price. That's IT work. But the actual record that says Walmart pays $500, that is master data. That's usually owned by the business users. You can have the perfect configuration, but if there's no record, the price is zero.
Okay, so we've got the basics. We can get a price on a sales order. But the source material says we need to shift our thinking now. We need to move from getting a price, which is operational, to protecting the profit, which is strategic. This is advanced pricing.
This is where the fun begins. This is where you separate the experts from the rest.
Let's start with scales. Volume pricing.
Basic concept. Buy more, pay less. But there are two types, and mixing them up is dangerous. The normal scale is what most people know. You buy 15 units, and because you hit the 10+ tier, all 15 get the lower price.
But then there's the graduated or interval scale.
Right. In that case, if you buy 15, the first 10 are charged at the high price, and only the next 5 get the low price.
It's like tax brackets.
Exactly. And imagine if you check the wrong box in the configuration. The customer expects a tax bracket style calculation, but you give them the bulk discount on everything. You've just lost massive revenue.
Now, what about group conditions? I loved the example in the notes. Red shirts and blue shirts.
This is a classic problem. Let's say you have a volume discount that kicks in at 10 units. A customer buys 5 red shirts and 6 blue shirts.
Okay, so they bought 11 shirts. They should get the discount.
You would think so. But structurally, SAP sees line item 10, red shirts, with a quantity of 5. Does that hit the target? No. Then it sees line item 20, blue shirts, with a quantity of 6. Does that hit the target? No.
So the customer gets no discount. Even though they bought 11 shirts, they'd be furious. They'd call up screaming.
Correct. And the sales rep would be helpless. A group condition solves this. It tells the system, hey, sum up the quantities of all the shirts in this order before you check the scale. So it sees 11 total, and boom, both the red and blue shirts get the discount. This is huge in retail and FMCG.
That is smart. Now let's talk about the margin protector exclusion groups.
This is one of my favorite features because it solves a huge business headache. Imagine a customer has a permanent negotiated 5% discount, but then marketing runs a summer promo for 10% off.
The customer orders, and suddenly they get 15% off because the discount's stacked.
And the CFO screams. This happens all the time. Companies bleed margin because they layer discounts on top of each other. Exclusion groups allow you to set a rule, like best condition wins. You put both discounts in a group, and the system compares them. It gives the customer the 10% because it's better for them, but it suppresses the 5%. It prevents double discounting automatically.
And you do that without writing code.
That's the key. Juniors write ABAP routines to check for this. They create spaghetti code. Seniors use transaction code OV31 to configure exclusion groups. It's cleaner, easier to maintain, and it just works.
Another tool for keeping things clean is condition supplements. This is about bundling, right?
Yes. Let's say every time you sell material X, you have to charge a mandatory handling fee. Instead of having the system search for the price and then search again for the fee, which is 2 database reads, you can bundle them. You add the fee as a supplement inside the price record.
So when it finds the price, it automatically drags the fee along with it.
It keeps your main pricing procedure clean and guarantees the fee is never forgotten. It's elegant.
Now, what about when you need to set limits? Like, the first 100 customers get 10% off.
That is condition update. It updates a database table -S071 every time the condition is used. It actually counts. So when the 100th customer gets the deal, the system knows to stop. Without this, your limited time offer becomes an unlimited loss.
It really is strategic. It's not just numbers, it's behavior modification. But even with all this structure, things break. We need to talk about troubleshooting, the red wires.
The most common failure is procedure determination. We mentioned the formula earlier: sales area plus division plus customer pricing procedure plus document pricing procedure.
The notes call this the red wire, blue wire connection.
Think of it like a circuit board. If just one of those variables is wrong, say the customer master has the wrong pricing flag, or the document type isn't mapped, the circuit is broken. The user sees no pricing procedure could be determined. and nothing works. It's a dead stop. You can't even save the order.
And the best way to debug this? I assume you don't just guess.
Never guess. You use the analysis button on the sales order. It is the single most important tool in SD. It shows you exactly which access sequence failed, which requirement was not met. It traces the logic step by step. Seniors read the analysis log like accountants read ledgers. It tells you the truth.
Another advanced analysis tool mentioned is condition indexing. Usually we search from customer to find a price, but sometimes you need to go the other way.
Right, reverse search. Imagine you want to increase prices by 5% across the board. You need to know which customers currently have a special price of $100. Condition indexing allows you to search by the price to find the customers. It's essential for impact analysis. Otherwise, you're just guessing who is going to be affected by a price change.
And speaking of reverse, there is reverse pricing. This one blew my mind a little bit.
It is tricky. This is for negotiated deals. The customer says, I have a budget of exactly $500. That's the total I'm writing the check for. You figure out what the base price is, minus the tax, minus the freight.
So you have to work bottom up. That sounds like a nightmare for the system.
It can be. You have to use a special calculation type to back calculate the base. It's risky because of rounding issues. Sometimes you end up with a fraction of a penny that doesn't fit, but sometimes the business demands it, especially in contracts.
The source also lists some common failures that really ground this in reality. Performance issues seem to be a recurring theme.
It always comes back to the access sequence. If you have 50 tables in your search strategy, or if you aren't using the exclusive indicator, you are forcing the system to do unnecessary work. We've seen systems where pricing takes 10 seconds to calculate. That kills productivity.
And another one, revenue posting to the wrong account.
That's an account key issue. You have to check the mapping in VKOA. If you map a discount to a revenue account instead of a sales deduction account, your financial statements will be wrong. You're effectively hiding the discount from the auditors.
And nobody wants to have that conversation with an auditor.
No, you definitely do not.
It's amazing how connected this all is. Pricing talks to master data, it talks to finance, it talks to logistics.
That's why I love this topic. It's the nervous system of the entire order-to-cash process.
So let's try to synthesize this for the listener. We've gone from the basic question, what is the price, to the advanced questions.
Why is this the price? And how do we protect the profit?
And that transition is what defines the move from junior to senior.
Absolutely. The junior consultant sees a requirement and thinks, I'll create a new Z table or write some custom code. The senior consultant looks at the standard toolbox, exclusion groups, supplements, group conditions, and builds a solution that is robust and upgrade-proof.
And they use the analysis tools to diagnose, not just guess.
They don't just patch problems, they engineer solutions.
We'll wrap up with this final thought from the source material, which I think puts it all in perspective. Pricing is where SD earns its salary.
Think about it. Logistics moves the goods. Accounting records the money. But pricing decides how much money.
If the logistics are a bit slow, the customer is annoyed. If the accounting is a bit late, the books are delayed. But if the pricing is wrong,
then the revenue is wrong. And if the revenue is wrong, nothing else matters. You can execute the perfect delivery, but if you build it at a loss because your exclusion group didn't trigger, you have failed the business.
a sobering thought to end on, but an empowering one for anyone mastering this module. You are the gatekeeper of value.
Precisely.
That's it for this deep dive into SAP SD pricing. Thanks for listening, and keep those margins protected.
See you next time.